Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why New York Community Bank posted earnings that were better than analysts feared.
Plus, we'll discuss how McDonald's sales are being impacted by war in the Middle East.
But first, we dive into big tech and Amazon. Amazon's cloud unit posted the strongest sales growth in a year.
It's really a sign that the retailer's most profitable unit is recovering from a slump as businesses resume spending on technology products, including AI services.
Despite this, Amazon's sales forecast for the current quarter fell short of analysts' expectations, reflecting concern about the main e-commerce business.
For more, we're joined now by Anurag Rana, Bloomberg Intelligence technology analyst. We first asked him for his big takeaway.
I think the big spike in AWS profit is something that really alarmed us because, that was a number we weren't expecting for, honestly, a few years. So if you look at it, AWS margins, operating margins came close to 38%, little over 37%. And that was like 8 points or 8 percentage points higher than what Street was looking for and 14 percentage points over last year. Absolutely phenomenal. I think that's really what I am hoping that investors are focused on rather than all the other things.
All right, Anurag, give us a sense, if we just step back, give us kind of the market share layout. How does this market look between some of these big players like Microsoft and Google and Amazon?
So Amazon only plays on the infrastructure layer, which is trying to give people raw material to build their applications. And with that, they have a commanding market share, over 40% of the market. And in fact, they have maintained that for a while, which is surprising because Microsoft has been gaining share on it for a very long period of time, but from smaller players. And also the market's growing very much. So Amazon's currently at revenue of over $100 billion in this market. But overall tech spending is north of $2 trillion, frankly. So there's a lot of room to grow for everybody, not just Amazon, but Amazon, Microsoft, Google, even Oracle. All of them will grow in this market.
So if we take a look at the different layers of how AI kind of plays into cloud, the one area where Amazon maybe isn't getting as much market share, and maybe they're still developing that, is the consumer-facing side. What can they do there? What is their growth opportunity there?
Yeah, they have a lot of, I would say some apps that are working on it, but really the reason why Microsoft is ahead right now in that game is because of OpenAI. They have a partnership with OpenAI and they run OpenAI's backend, which is when you do a search on ChatGPT, Microsoft is running those searches in the background, or the application runs on it, which is why Microsoft is getting the benefit of it. For AWS, the big benefit is going to come from companies or big corporations when they go out and build their AI applications. There's a high likelihood they're going to choose AWS as much as they're going to choose Microsoft or Google. And that's really what Amazon's betting on.
So you mentioned the margins, high margins at AWS. Can they maintain those margins? What are the risks for those margins?
Yeah, I don't think they can maintain them only because they have to spend a fair amount of money in order to, fulfill the demand, expanding in data centers, buying new hardware, buying chips. So I'd be very surprised if we see that number again for a very long period of time. And frankly speaking, I'll be happy with the 30% margin for the next several years while they make sure that they're doing the right investments to drive double-digit growth rate on their top line.
Let's talk about those investments. So they said they're going to, quote, meaningfully step up their CapEx to pay for all this AI infrastructure, but there was no number given. When Meta said that, the market didn't like it. What was the pass here that Amazon got?
Yeah, but Amazon's basically showcasing that they actually have been doing this successfully in terms of expanding data centers based on the capacity. So, before going in, they had close to $15 billion yesterday in the first quarter in terms of CapEx. And it's going to go up over the next quarter. So we think it's going to be north of 65 billion at this point for all of Amazon, with most of it going to AWS. But there's a reason for it. They are getting contracts to fulfill cloud demand, or they need to be able to expand that to fulfill that massive cloud demand.
Anurag, you know what I did not see in Amazon's report? A dividend. Why is that?
Yeah, I mean, again, they're going to spend that $65 billion next year on capex also. So I'm okay with not having a dividend for a while. I would rather.
But you're a tech analyst. You guys think that if you put out a dividend, it signals that you're no longer a growth story.
Yeah, it's a kiss of death. I'm not a big fan of it.
It's not. Microsoft, Google, they disagree with you.
Yeah, IBM kind of agrees with me at this point on that. I mean, so look at IBM. I mean, they have a massive dividend yield. I would rather they take that money and buy a bunch of new HashiCorp kind of companies that are growing at 15 to 20%. That will change the face of the company, make them even more relevant in the tech space than they are right now. So I'm always in that camp that when you are a tech company, you gotta constantly reinvent yourself. Otherwise, somebody will come and eat your lunch.
I mean, Anurag and I, we just fundamentally disagree on this. We agree to disagree. We go to our separate corners.
Can I ask a dumb question for the two of you then? Is there room for both of you to be right? Like, can these tech companies throw off enough cash that they can reinvest in a healthy way and also pay a dividend?
Yes.
Anurag?
Yes, absolutely, Alex. I completely agree with that. Because what happens is if you give a very small token dividend, it opens the doors to a lot of institutional investors that are bound by their charter to only invest in companies that pay a dividend. So there is a logical reason to do it, but I'm okay with Amazon's going to take a year or 2 years to get to that path.
All right, so there's a where you can both be right.
There's a place where we can meet in the middle.
Is there a capex number that you wouldn't like from Amazon? They didn't give a number.
No, not at this point. The only reason is because we see forward contracts. As of this morning, when they filed their 10Q, we saw cloud commitments go up 29%. I mean, that's a very big number. And frankly, when on the enterprise side, we haven't even seen orders coming for AI at this point. AI orders are only coming in from consumer applications like ChatGPT, people running that at this point. Over the next few years, we should see a massive spike in people creating new applications or companies creating new applications, and that's going to only drive more growth for AWS, Microsoft, and Google.
Our thanks to Anurag Rana, Bloomberg Intelligence technology analyst.
We move next to the EV space and Tesla. CEO Elon Musk recently paid a quick visit to China, and it paid immediate dividends for the EV giant.
Tesla received an in-principle approval from government officials to deploy its driver assistance system in China. Tesla also reached a mapping navigation deal with Chinese tech giant Baidu and met requirements for how it handles data security and privacy issues.
For more on all of this, we were joined by Craig Trudell, Bloomberg Global Autos editor. Craig began by telling us that his tentative China deal has been in the works for some time.
It wasn't necessarily the case that this was, kind of an overnight thing. Actually, the last time that Musk was in China, this was something that we reported at the time was on the agenda. It's been something that Tesla has been after for quite some time. And it's increasingly a way that, car makers are competing in China is how advanced is your driver assistance system, that keeps you from crashing, that keeps you in your lane, that allows you in some cases to take your hands off the wheel. But in all cases, you absolutely are responsible for the car. And no companies are taking responsibility, legal responsibility, if you get into a crash. With the exception of some very small sort of limited fleets and contained areas. And there are quirks, as you might imagine, by market for what is required to be able to offer these systems that really need to be safe and also need to have controls for data collection and the cameras used to navigate the surroundings that these cars are going to need to pilot around. And that's been a hang-up for Tesla and other international companies that they need to, in all cases, work with local Chinese companies for things like mapping and navigation. So one of the key sort of takeaways from this trip was Tesla agreeing to do that with Baidu in China.
So who owns the stuff?
It is, importantly, it's a matter of ownership and where it's kept. And so, this has come up years ago, actually. Tesla had a bit of a hang-up where their cars were banned from, being in the area of military compounds and other sort of sensitive parts of China out of concerns about, any information that cars were gathering. And there were concerns about whether any data was going from Tesla's China operations back to the U.S. And so Tesla needed to sort of reassure China that any data collected in China will stay in China. And so that has been, something that they've had to sort of acquiesce to as of, several years ago. But they needed to still sort of, clear, approval for, making sure that their T's were crossed and I's were dotted in that respect. And they needed this deal with Baidu. It does seem to be the case that they need to meet other conditions in order for FSD to be offered in China. It's still not a done deal. But what, sort of hoops they still have to jump through are a bit unclear at this point.
So how does this change, if at all, kind of the competitive landscape for Tesla in China? I know you guys have been reporting a lot how some of the local EV makers have really become very good and very competitive.
Yeah, I think it absolutely is something that's been missing for Tesla, that assuming all goes well here, it will no longer be a sort of strike against them among consumers who really, want the most cutting edge technology. It remains to be seen how big a deal it will be for Tesla from a revenue standpoint, because we don't know at this point how much Tesla will be looking to charge for it. We don't know, to what extent they may have to share some revenue with some of their partners. It's not clear whether Baidu maybe gets a cut, in the U.S. Tesla and throughout the world, Tesla has made a point to really be, want to be vertically integrated, and that's, fancy talk for in control of its own destiny. They were willing to sort of acquiesce in this case, I think, because they really could use this boost in China at a time when their lineup is getting a bit tired and they're losing a lot of market share to companies like BYD.
Well, this also raises the question, too. It doesn't take a lot of news to get Tesla stock moving. Not that a trip to China wasn't a big deal, but like you said, there's so many questions as to the actual revenue driver and what it's going to mean. I mean, you have to wonder, it's not going to take a lot for any kind of shorts, Craig, to cover.
I think that's right. And this is also a name that, options traders absolutely love. It's sort of like the meme stock that has lasted as a meme stock as that craze has sort of faded away. And so, anytime, to your point, Musk is able to sort of get some momentum with, the narrative, it tends to lead to big swings. So, early this year, I think he lost control of that narrative, and it's not at all a mystery as to why that is, looking at last week's earnings. But I think he was really able to sort of change what people were talking about last week. We'll see whether or not, this is mostly talk as opposed to, going to lead to real sort of meaningful change in Tesla's earnings trajectory, which has not been trending in the right direction.
Our thanks to Craig Trudell, Bloomberg Global Autos editor.
All right, coming up, we're going to break down why McDonald's is now looking to focus on affordable prices in the U.S.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We look next at the food service industry at McDonald's. The fast food chain's quarterly sales fell short of analyst expectations in the first quarter, and results were hurt by slowing growth in the U.S. and boycotts related to the Israel-Hamas war.
The restaurant chain now looks to focus on affordable prices in the U.S. For more on all this, we were joined by Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst. We first asked Michael for his reaction to McDonald's quarterly results.
I'd say the biggest takeaway was, the fact that April's flat so far in the United States. That's trailing the industry level, the industry data that we get. So, and also, Burger King showed an acceleration in the U.S. in their U.S. numbers. So I would say that was the biggest surprise. McDonald's still on a 5-year trend is vastly outperforming Burger King and most of the other quick service names. But there seems to be some slowing. If I was to guess, some of that bad press around the $18 Big Mac meal in some markets, could be hurting, because we are seeing U.S. consumers really push back against price increases right now, and they're being more picky about where they spend their money.
Mike, I see just in the Bloomberg reporting here, executives have also said that low-income consumers in the U.S., which is an important part of the company's customer base, are pulling back. Does that mean we're going to see more promotions, which might put pressure on the margins?
Yeah, McDonald's has come out and said they're going to focus more on their value menu. They're going to continue to offer promotions, a lot of them through the apps, So it looks like a full-on value war is here. I mean, Burger King, King's gonna be a little bit more careful with their discounting because in the last 5 years or so, they've gotten too aggressive and it hurt franchisee margins. So they kind of poo-pooed that a little bit, but we think a full-blown value war is here and it's on the table for 2024.
So does the value war take into account a bigger burger? Is that the deal?
Well, value, it's measured in a couple ways. It's not just the price, but it's what you get for the price, right? And so I'm sure McDonald's has done their legwork and they have some customer feedback that says that they want some bigger burgers on their menu. And so that's going to be interesting. They said they're going to start testing it in the second half of this year. So it may not hit the United States for quite some time.
Sorry.
But yeah, there's a couple ways to measure value.
Hey, Mike, what are the McDonald's of the world and, the other restaurant companies you talk to, what are they saying about these GLP-1 drugs? Are they really going to impact their business?
I don't think there's too much worry about that anymore. I know that was a big thing last summer and into the fall, and it really impacted the prices of some of these quick service restaurant chain stocks, especially McDonald's. But I've seen a lot of different reports out there, and the amount of people on these drugs ranges from 7 to 12 or maybe 15% best case if once they get to like maybe a pill form instead of a shot, and we don't know about long-term side effects from some of these drugs. So I think initially there was some concern, but over time, McDonald's and these other chains, they're going to figure out how to make a 7 to 12% smaller cheeseburger, right? They're getting smaller anyway because there's a historical situation in the cattle market right now. And so beef prices are going to continue to stay elevated here for a couple of years. And so chains are already starting to try to, solve for some of these problems, ahead of broader adoption of
Yeah,
GLP.
I mean, you have to think that shrinkflation is going to hit in many different ways.
Yeah.
But before we let you go, we have about a minute left. So who wins the value war right now, based on what you've seen?
It's interesting because, McDonald's historically has. And so that's what's most interesting about them underperforming in April. Burger King is an interesting one because, they have easier comps. They struggled coming out of the pandemic for a few years, right? And so they have easier comparisons to lap lower average unit volumes at the store level. And so there's room for some upside there. Chipotle absolutely continues to knock the cover off the ball. And, McDonald's has scale, right? And so when they really start pushing on value, everyone else is going to feel it. So I'm confident that McDonald's can kind of turn the tide here a little bit because they can just offer burgers and other items at prices their competitors just can't match.
Our thanks to Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst.
We move now to regional banks. New York Community Bank posted quarterly results that were better than analysts had feared, and the lender also outlined a plan for reshaping it into a more diversified and profitable bank.
For more, we were joined by Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. regional banks. We first asked Herman for his key takeaways from the bank's earnings.
We learned a lot, so they gave a path forward. Remains to be seen if everything's going to go in lockstep to their expectations, but they basically said they're moving to a 3-year plan with a transition to be more of a commercial bank and expecting any sort of credit issues to be mostly cleaned up this year with an earnings loss for the year, but it was a low bar and they cleared it pretty healthily.
Okay, so just to review here, their risk was rent-controlled apartments in New York City, a very focused business they were in.
Very niche.
Are they exiting that business? Are they fixing that business? How are they going to make things right there?
The part of the 3-year turnaround is de-emphasizing that multifamily rent-regulated piece. There's $30 billion of those loans now on the balance sheet. They can't get rid of them because there's not going to be a lot of buyers, and if they would have to sell, they take a big discount and take a big hit to the balance sheet. So they're just going to manage through it. They've been building their loan loss reserves on these over the past couple quarters. So they've built up their reserves to pretty much in line with peers, but that's one of the unknowns is how credit quality is going to perform going forward in a higher for longer rate scenario with respect to these rent-regulated loans.
There was an article at the Bloomberg today that talked about how rent-stabilized apartment buildings are actually, the rent's going up. And if you sign 2-year leases, the top can be like 6.5%.
Right.
When I was in a rent-controlled apartment, like it was like 0.5%. Like
Right.
it was really, really low. Are those kind of increases enough to really help the likes of a New York community bank?
Yeah, it helps. But a lot of the issues that these borrowers, these landlords are facing is higher debt service coverage ratios and higher operating expenses, right? Because if you have to, gave an example, if you have to replace an HVAC unit, that costs 30% more than it did 2 years ago. So all of these operating expenses pile up, but then you can't raise your rents to commensurate with your higher costs. So that's the issue, and the higher rate issue where they have to refinance at higher interest rates.
So rent stabilized apartments, I've never been in one. Do they not just rise on the rate of inflation, or are they really fixed?
No, it's fixed.
Well, that's a tough business to be in if you're a landlord, isn't it?
Right, it is now. And there was a change in the New York state laws that really capped how much the rents can go up every year. So we're seeing the repercussions of that for banks like New York Community.
So I lived in one 20 years ago for a while. I had a 2-bedroom apartment, huge, on 183rd Street. And I paid $850.
Wow.
And it saved me. Like, there's no way.
May I ask just why you would give that up? Aren't those things you keep in your...
I got married.
Okay.
And my husband owned his apartment, so that was just better.
Ooh,
yeah.
interesting.
But like the dream was that it would go co-op or something, and then I could buy it for like crazy cheap. But also there was no incentive on that end to like fix it up. Like it hadn't been fixed in forever and 20 years, and the kitchen was horrendous. But there's no incentive to like spend money to do it, to just then raise your rent a nominal amount, because it's sort of like a utility, right? Like you can only raise it a certain amount, even if you put a certain amount of work in, then you can raise it a little bit more, but it's not a huge profit generator from that end. But man, that was nice.
That was nice.
I had a lot of closet space. So when they talk about you know it for diversification, right? They want to be a diversified bank. What does that mean for them?
Yeah, what that means is they want to tilt more towards business lending, commercial lending. They talked about their business portfolio is about $20 billion. They want to grow it over time to be $30 billion. And the new CEO who came from One West, who was former head of the OCC, he alluded to the fact that they're going to hire more folks that he used to work with in the past to really build this commercial lending franchise. The issue is that they're losing your existing commercial bankers, your folks that are focused on deposit inflow. And these are former Signature employees, and they talked about losing 35 teams out of 134. So you've got folks leaving, but then you got to refill them. So there's a lot of work to be done there.
All right, let's step back and take a look at your coverage in general, the regional bank coverage. I'm looking at the SPDR S&P Regional Banking ETF. What's the call out there when you talk to institutional investors? Can we buy these things?
Yeah, the low was in October, and you've seen banks come back a little bit. What's helpful is that the banks are talking about troughing net interest margins and net interest income, so that's good to see, and they expect a improvement in growth in the back half of the year. Really, to us, it really hinges on what the rate backdrop is. And if rates are going to be higher for longer, the optimism that bank management teams are talking about for a back half return of loan growth maybe just won't materialize as well as they currently expect. So there's a lot of questions if we do get that second half resurgence, but bank management teams are talking about it. On the other side, we still haven't seen the shoe to drop on the credit quality front. And really, the strong and resilient economy has really helped that front. Remains to be seen if things really do deteriorate, then you're going to see a pickup in charge-offs as well.
Are deposits moving anywhere? So I have a Citizens Bank a couple blocks from my house, and I'm seeing a 5% CD, man. Right. I'm not getting that at Citi.
Right.
Are we seeing deposits move?
We have seen stability. So in the first half of last year, when we went through the regional banking turmoil, there was a lot of deposits that were leaving to go to the Bank of Americas and the JP Morgans of the world, especially the large corporate deposits where they thought it would be much safer to be in a too big to fail bank. banks have recalibrated their pricing, like you talked about the 5% CDs. So that's helped stabilize their deposit base. And
that's a large payout. Like, that's not going to be nothing.
Right. That's not going to be nothing. The good thing is that overall, with short-term rates now pretty much stable for the past several quarters, the banks have been keeping their deposit costs fairly manageable. So we're not seeing that big jump in costs that we saw last year after SVB's failure.
All right, my personal proxy for a quality regional bank is M&T Bank, your former employer up there in Buffalo. In order for that name to really work, is loan growth the thing I need to focus on? I need to see loan growth for this one to work?
You need to see more confidence in loan growth and also their asset quality. So the potential knock on them is they tilt more towards commercial real estate exposure just because of their historical leanings. They've been trying to reduce that over time, but they do screen higher on commercial real estate. So if we get more stability there and less loss content, then that stock can really work, even though the valuation's still higher than your typical regional bank.
Our thanks to Herman Chan, Bloomberg Intelligence Senior Analyst for U.S. Regional Banks.
Coming up on the program, a look at why U.S. solar makers are seeking more tariffs on imported equipment from Southeast Asia.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We move now to Intel. The stagnating chip maker is committing $28 billion to build a factory in Ohio called Ohio One. And if all goes well, Intel will be able to credibly compete for contracts to manufacture state-of-the-art chips.
This is the subject of the Bloomberg Big Take story entitled Intel is betting $28 billion on making Ohio a global chips capital. For more, we are joined by one of the story's co-authors, Max Chafkin, Bloomberg Businessweek senior reporter. We first asked Max for more context on his story.
So Intel at one time was one of the world's largest companies. It is essentially one of the founding parts of Silicon Valley. It's the reason it's called Silicon Valley, in fact. But over the last decade, Intel has really suffered. They've sort of fallen behind both the big chip makers in the U.S., NVIDIA, AMD, and they've fallen way behind on manufacturing, behind TSMC and Samsung. And that's a big problem for Intel, this large, important American company, but of course it's also a problem for the United States because Intel at this point is the only company making state-of-the-art chips or even trying to make state-of-the-art chips in the US. And over the last few years, they've pursued basically a turnaround, and that turnaround is betting entirely on manufacturing. You mentioned the project in Ohio. President Biden has talked about that a fair number of times, including bringing it up in the State of the Union address. There are also major, tens of billions of dollars projects in Arizona and Oregon. This work is being backed with a lot of money from Washington, $19.5 billion in grants and loans from the Biden administration. So it's this big, ambitious attempt to turn around, a really important company that's fallen on some hard times. It's also a big part of the White House's geopolitical strategy.
They're going to build a mega fab. What is a mega fab, and are they going to get it done here? Because this is big numbers.
Intel's put $28 billion into this Ohio site so far. The site is it's about 45 minutes north of Columbus. It's in a bunch of farmland. It's really muddy. You go there now, and what you really see is just a ton of construction. The idea of a mega fab would be to have multiple chip factories. Each one of these things, you're talking on the order of $10 billion. They're going to build 2 to start. And it sounds like a crazy amount of money. But at this point, that is what you need. If you want to be able to compete to make chips, say, for the iPhone or for AI chips, to try to compete with NVIDIA, which Intel, really desperately would like to do. But it just isn't quite there yet on the manufacturing side yet.
We have heard, though, of a lot of companies announcing projects and manufacturing facilities that don't get done, or the timeline's pushed out, or it gets pared back. Where is Intel in that?
Yeah, we saw this, of course, during the Trump administration. There has been like a political shift over the last, I'd say, decade, where there's a lot more enthusiasm, both from Republicans and Democrats, for sort of state-backed industrial projects. Not all those have gone great. I mentioned this story that one of the sites that Intel was looking at was this Wisconsin site outside of Racine. People will remember that because Donald Trump called it the 8th wonder of the world 8 or 9 years ago, talking about Foxconn. Foxconn opened there, but it hasn't proven to be the job creator they want. And there's a risk with this project as well. I will say, these semiconductor factories, they are like some of the biggest and most ambitious kinds of factories you can build. There are already, like I said, it's muddy. There's not a lot going on there right now.
Literally
and
and figuratively.
There are already, 1,400 construction workers working on that site today. Long run, they're saying it's going to employ something like 7,000. And you hear that, you think, okay, 7,000 construction workers, like that's a temporary job, not a full-time job. But the thing is, with these sites, construction could go on for decades.
Wow.
It's conceivable if they really built this thing out that many of these construction workers could work like their entire career building these things, because the nature of the business is you have to keep reinvesting and you have to keep building new fabs. And the way that analysts and so on are looking at this industry, there's going to be a lot more demand for chips in the coming decades.
And boy, reading your story and Ian King's story here, this is a great example, or just certainly an expensive example of onshoring. The money for Intel in Ohio, but then you guys also report $12 billion for a plant being built in Arizona by Taiwan Semiconductor, $6 billion for one in Texas being built by South Korea's Samsung Electronics. So the money is coming into the U.S. to onshore this chip business.
Yeah, I think this may turn out to be, a thing that people are talking about in the next few months as we get closer to November. This has been a big part of the Biden administration's industrial policy. It has components of sort of a jobs program because, like, as I was saying, these are construction sites, potential good jobs for people. Even in these plants, which are run by robots, people still work there. And the other thing you have is this kind of competition with China. And the Biden administration really seeing, post-COVID, post-chip shortage, that the United States needs to sort of be able to produce at least some of its own high-end chips, because right now that is not the case. Now, the interesting thing is that idea, the sort of China competition idea, has devotees in both parties. In Ohio is a state dominated by Republicans. The Republicans have been touting this as well. However, it's not clear if Biden doesn't win, it's not totally clear like how things might change with Trump. But right now, it really seems like, the U.S. is all in on investing in chip factories. There's even talk of a second CHIPS Act, the idea that we might even appropriate more money for this stuff.
Not to talk about energy, but let's talk about energy. How are they going to power this kind of fab?
Excellent.
Yeah, I mean, that is a huge issue. And talking to Intel, that is like one of the main issues in terms of where you're going to site one of these things. So when you're talking about building a fab, you're talking about essentially you need a lot of space, you need energy, and you also need water. Semiconductors use tons and tons of water. Now, Intel, what they say is they are really mindful of their environmental stuff. They're, all in on sustainability and so on. A lot of the stuff that many companies say, although I have to say they are already recycling a huge amount of water at these plants. And for this industry to have a future, it does have to, continue, improving on sustainability.
Thanks to Max Chafkin, Bloomberg Businessweek senior reporter.
On Bloomberg Intelligence Radio, we bring you all the top analysts providing in-depth research and data on 2,000 companies and 130 industries.
We also have something here at Bloomberg called Bloomberg New Energy Finance, or BNEF. The idea behind it is to provide data on commodities and power transport, industries, buildings and agriculture, and also new technology.
This week, we looked into U.S. solar manufacturers, and several of them asking the U.S. government to slap tariffs on $12.5 billion of imported equipment from Southeast Asia. This is to help counteract what they say are unfair practices by overseas rivals.
But it also sets the stage for a sweeping trade probe that threatens to make power projects more expensive. For more, we were joined by Paul Escano, Bloomberg NEF, a senior associate. We first asked Paul if we can impose tariffs on the stuff we need to decarbonize.
We should not. And the U.S. has been doing it for a while, actually very quietly, since 2012. So it's not a new thing. And it's really made solar more expensive in the U.S. than everywhere else in the world. So the difference is the U.S. has had very generous subsidies for solar for a long time, and that offsets some of those higher input costs. But is it the most efficient way if you're trying to decarbonize quickly and grow a sector quickly? Probably not.
So what are we talking about here? The panels, the more than the panels? What are we talking about here?
Yeah, we're talking mostly cells and panels.
So the panel gets the sun. Where does it go from there?
Correct. It goes into an inverter, which is the brains of the system, and the inverter translates that direct current power that the panels produce into alternating current power, which is the one that we use.
Thank you for explaining. Because I represent like 99% of our listeners.
This is true. Sorry about that. Yes. So what part of that would be taxed with a tariff?
The panels. But what typically those tariffs target are the cells, which is the cells is essentially what composes those panels. You stack them together and you assemble them, because the cells is really the true technological component of the panel. The panel is just like cells assembled, basically. So what some of these companies are trying to do is impose a new set of tariffs on, like, there's already tariffs on panels coming from Southeast Asia, and there will be new tariffs coming in June, but this would be an additional set of tariffs that they're trying to impose.
Why can't these companies, like First Solar or something, make these panels themselves?
They do. So First Solar sits in a different league. First Solar has a different technology. This, we're talking about crystalline silicon technology. First Solar uses a different type of technology called thin film. And First Solar has been producing their own panels for a long time, and they have really ambitious plans in the US.
But I guess that's the point, right? Because they don't want the cheaper ones coming in and then diluting what they're able to sell. So why can't, I guess the better question I should have is, why can't they make it for as cheap as the ones that Southeast Asia is selling for?
Yeah, the question is probably, the answer is not going to surprise you. Just higher input costs, higher production costs, higher labor costs. You cannot really reach the same scale that you can in the Asian countries in the US. It's not just about the factory that you have, where you assemble or making the cells or making the panels. It's about all of the adjacent supply chain. And China and some of these Asian countries, and by extent from being so closely to China, they are able to ramp up all of the adjacent supply that they need in a very efficient way. So typically, those mega bases in China have massive solar factories. And if you go across the road, that's where your aluminum frame supplier is going to be. If you go in a little bit further down the road, that's where your glass supplier is going to be. So it works in coordination quite nicely, and that helps improve efficiencies and lower costs.
It doesn't seem high tech to me. Why would I care if China's producing them, other than if at any time they could stop producing them?
Because you're saying that there's no cybersecurity or security measure for that.
Don't I just want the cheapest panel?
That's correct. And that's exactly what we've been trying to say for a long time. Solar manufacturing is a terrible business to be in. Competition is really fierce. We're typically go through all these swings of overcapacity, a bunch of bankruptcies, and then new companies arise from nowhere, and there's, again, overcapacity. The IP and really the technological know-how there is really not that difficult, and I really don't understand, we don't understand why you would want to throw so much money at building this industry in the US, unless it's a geopolitical hedge, which is something that obviously begs a very different question and a very different set of analysis.
What kind of, let's say that these tariffs do go through, so this request could raise the prospect of tariffs as high as 271.5% later this year. Let's just pretend that happens.
Yeah.
And I want to install a solar panel on my house in Massachusetts. What's that going to cost me now?
It's going to cost you a ton more money.
A ton. I don't like a ton.
No. I mean, the 271% is very unrealistic. So what's happened typically in these petitions is a little bit of the boring stuff. But what happens what happens is they file this petition, and then if the U.S. Agrees to investigate these companies, they have to prove that the amount of subsidies that they receive is not as high as what that countrywide tariff would look like. So typically they get a tariff rate that is much lower than the 271% that you're referring to. And it's can range from like 30 to 50%. It just really depends. But the bottom line is, if that were to happen, obviously imports from Southeast Asia would be completely ruled out in the US, and that would really trigger the renaissance of the US manufacturing industry, but you would have to pay more for your panels.
Thanks to Paul Iscano, Bloomberg NEF Senior Associate.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.